In this video, we're going to be talking about two different stocks. One of these pays dividends and one of these does not. But I still believe that even though the stock does not pay a dividend, if it fits your portfolio, this is a strong buy. I am now buying in on this stock. And we will also be talking about just an overall weekly portfolio overview. We usually do this every Friday. I didn't get to make a video on Wednesday for a number of reasons, so I wanted to kind of mix two videos into one for this one. But if you're new to the channel, make sure to subscribe, turn on post notifications so you don't miss out on any future videos. But enough of that talk, let's just get straight into it. So the first stock on this list is actually Google. I'm sure you've heard a lot about it over the past few days, especially with its brand new news of a 20-for-1 stock split. So literally this share right here for $2,900, you divide that by 20, that's how much the stock's going to be worth. So like around $150 per se. And I believe right now is a perfect buying opportunity because stock splits usually almost always send a stock upward just because of the psychological effect on it. And I'm not saying that's the only reason why you should buy. We'll look into an analysis on Google stock, but you want to be, my personal opinion, not financial advice, you want to be buying GOOGL. And I say that compared to Goog because really the only difference is that for the one with the L, Class A shares, you have voting rights. And if those don't really matter to you, which to some investors they don't, I just think it's better to have them than not have them. Then you can buy just the 4-ticker Goog. But let's go ahead and talk about Google right now, just the stock. So they have an earnings per share of $115 a share, which is just insane. A market cap of $1.82 trillion and a forward PE of 25.5, which is really good. Like that's solid stuff in my personal opinion, especially them being a kind of a tech giant. That's really, really good. Now looking on Morningstar, fair value, it says Google's at an 18% discount. That's top-notch stuff. Looking on even more factors, 30 buys with absolutely 0 holds and 0 sells, giving the stock 22% upside. Now, looking on just some more things, 1-year target estimate right here, that's $600 up. That's a big return now. It's going to be different whenever they do this 20-for-1 stock split. Every one share that you own right now, if you own 1 share, you'll own 20. If you own 5, you own 100. And one thing to think about is if you own 5 shares right now, options on this are probably insanely expensive. Now, they're going to probably decrease in price as the stock price decreases. But let's say you owned 100 shares of, or 5 shares of Google right now. Once they do this split, you'll be able to sell covered calls on this, which is a really good bonus tip. Just a little aspect. Expectations from analysts, $114 a share to $134 in the next year. That's a massive increase. Looking on more stuff, sales growth, expected to do even better. 15% growth, 17% growth. Look at how their revenue has been doing. Net income, incredible. Revenue doing great. Profit margins up even more. Operating income, really good. Net change in cash, they did lose some cash, but that's okay. It's not necessarily the end of the world if you lose some cash. So it's really good. Maybe they're spending that cash for a number of reasons, but it's definitely being put to good use if they're increasing their revenues and income total. Now, institutions are really liking the stock. A lot more inflow than outflow, and I am buying more Google. I'm not actually putting it into my dividend portfolio right here. I'm putting it into another portfolio that has growth. It's literally got like 5 stocks. I want to say it's like Google, Apple, Microsoft, Nvidia, and one other one I honestly completely forgot. It's just literally some growth stocks I don't want to buy in there. I know it's probably bad that I forgot. But you know what? Let's just go ahead and look. Research. I'm going to go to my pies. I just made this. I want to say it's this one right here. Here it is. 6 holdings. Google, Nvidia, PayPal, Microsoft, Amazon, and Apple. Those are the stocks in my growth portfolio. Google going to be my number 1 weight, especially after the factors that we just saw in the company. Let's go ahead and talk about stock number 2 on this list, which is going to be ticker JPM, JP Morgan Chase. Really solid dividend company. I do believe with higher interest rates coming, especially rates expected to hike up in March, it's good for financials. I think JP Morgan is a really safe bet. With them being one of the top 10 largest banks in the entire world, that's really big stuff. Their PE forward is 13.5, which is a lot lower than some of their competitors. I mean, not a lot lower, but some of their competitors are around 14, 15, 16. So it gives us a better valuation. Over the past year, they're up 12%. And I think right now is a pretty good time to buy as the stock is down from 170 right now to about 148. So giving you a better price. Now looking on dividends, really solid stuff. A+, B-, C+, 25% payout ratio, which is really good for a bank. 9-year dividend growth record, and 15-year growth rates. So you're getting really solid dividend growth increases and a total yield of 2.67%. Now, looking on to some statistics on this company, I want to just talk about, sorry, this is JP Morgan, sorry. So profit margin 37%, operating margin 45.8%. Those are better than profit margins from Bank of America with 34% profit margins and Wells Fargo with 26% profit margins, which is really good. Now, they did announce some factors, right? Sorry, I have a ton of tabs pulled up. That's my mistake. But we have a ton of different things going on right now. Quarterly revenue growth up down 1.8% year over year, and earnings growth down. We'll look into the factors why that is, but it's not concerning to me right now at the current time, and I do believe J.P. Morgan is a great hold for the long term. Let's go ahead and talk about why things are kind of down. So for the consumer and community banking, their expenses were up. A lot of expenses were up in kind of all their sectors, but it was driven by increased compensation, technology, and marketing expense as they continue to invest and grow the business. So that's still a really good thing to see. Now, revenues are looking really good. Good stuff. Q4 2021, solid stuff. We really do like to see that. So total revenues is still looking really good. Now, fees for investment banking grew up 37%, predominantly driven by higher advisory fees. We're seeing a lot of investment banks starting to pay a lot more to their incoming new employees and their higher ups, especially their higher ups. But markets revenues, they were down, driven by challenging trading environments and rates. We've seen a big kind of decrease in the market over the past few weeks and past months. And then they had expenses driven by higher compensation expense, including investments, as well as higher volume related brokerage expense and higher legal expenses. Now, this is the big one. Net income down 38% year over year on their commercial banking, driven by lower credit reserve releases. So it could be some credit risk that they weren't expecting. I still believe JP Morgan has huge upside potential. Q4 2021 still looking very good. Net income looking very good on these different things. I really do like to see this. Now, expense even up right here. Their expenses are up, and it could be a number of reasons. When you look at it, maybe it's even inflation. Just things are costing more. I do believe this is not a massive concern, and I think we're buying the stock at a good time if you get in now. Looking at the fair value, about 152. So I do think it's fairly valued right now. I don't think it's undervalued right now, but I do believe this is a great time to buy. We have some really good price targets. 175 is the median. The low is 125, but the average is about 174. So that still gives you some really good upside, about 13% upside on the stock, if I'm not mistaken. Now, about institutional activity, not the best. It's pretty flat when you really think about it. There's been some selling pressure, but recently there's been more buying pressure on the stock. Now, if we go look right here on their revenues, still trailing 12 months, total revenue is the highest it's been yet. Net income, we'll see right here, it's still doing really good. Look at the grand scheme of things. It's still very solid numbers that I really do like to see on this stock. And that is it for JP Morgan. I mean, if you want to look, growth on sales is not expected to do the best, but it's a bank, so you can't really expect the best. They are slower growers, but still there's a lot of upside potential in this stock. And I do think it's a safe bet in the current economy that we're kind of experiencing in this interest rate market. Now, let's go ahead and talk about my portfolio and how it did this week. So looking at my investment portfolio, my dividend stock portfolio, over the past week, I'm up $367, which is 3.26%. The past day, I'm down pretty bad, $211. I have a pending buy of $325 that is going to go through tomorrow in the morning. I'm making this as of Thursday night. I have some stuff going on tomorrow. So I'm pending buy of $325. Looking at the activity, I had a lot of dividends this week. From January 28th, I had a buy early in the morning. And then the 31st, I had $2.96 from ticker SPHD. I had $3.17 from JP Morgan Chase. I had $6.15 from Toronto Dominion. But then there was a deduction of 92 cents. That's because it's a foreign company. Then we have XYLD paid me 32 cents. QYLD paid me 86 cents. XYLD also paid me $8.17. And then we have Lowe's who paid me $1.44. That's really good stuff. It's nothing better than waking up seeing these dividend payments notified on my phone. My total portfolio annual income $391. Yield on cost a little bit higher than my total yield. It's just because the market's been a little bit whack over the past few weeks and months. and I still continue to buy and continue to buy the dip, as I cannot stress that enough. My annual income, expected dividends for the month is $22. March is 26, and April is 45, and it continues to just kind of keep this cycle. And as I continue to deposit more into my account and buy more stocks, its number will continue to increase, and that's what matters when it comes to dividend stock investing. But everybody, that's going to be it for this video. So if you enjoyed it, make sure to subscribe to the channel, turn on post notifications so you don't miss out on any future videos. Thank you for making it to the end, and check out M1 Finance if you haven't already. If you haven't, you can check out the link. It'll say M1 Finance. You sign up for an account, deposit $100, you will get $50 free dollars, 50. You can do whatever you want with that money. It's free. Thank you again for making it to the end, and I will see you at the next video.